We are pleased that you have joined us for today's webinar titled, What's a Business Worth? The webinar will last approximately 20 minutes, and at the end you will be given an opportunity to receive supporting materials by email, free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice. Linus now writes extensively for life insurance industry publications, and he speaks regularly at industry events. His new book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, written together with a CPA and a business broker, is available now for purchase on Amazon.com. Linus will draw on his legal, life insurance, and practical experience for today's webinar. And here he is.
Thanks, Lisa, and good morning, everyone. We're going to spend the next 20 minutes or so together talking about business valuation. Just for your own information, the webinar will be posted within a day or so on our YouTube channel. And if you feel like the webinar was helpful to you or would be helpful to someone else, feel welcome to share a link and get word out to others that may benefit from our content. Now, I mentioned that we're going to talk today about business valuation, and so you're probably wondering, what is it about business valuation that we're actually going to talk about that will be helpful to you? And I guess what I'd like you to do is I'd like to ask you to imagine that you're working with one or more owners of a closely held business, and you're having a conversation with them about the possibility of business continuation. And as part of that conversation, you ask the owner or owners what they think their business is worth. And you get the standard answer, which is, I don't know. What is it that you should do when you get that kind of answer, and how should you prepare to help the business owner come up with a valuation for a business, and why is it important to come up with a valuation for a business? Well, if your conversation has morphed into something of a buy-sell conversation, the valuation question can be really important because, first of all, for you, coming up with a value for a closely held business will help you understand the amount of life insurance that the business owners might be applying for on their lives in order to facilitate buy-sell funding. But even more important than that, I think it's important for stability and predictability for business owners to know what their business might be worth, particularly if they're going to do buy-sell planning. Here's what I mean. If they do enter into, let's say we've got two owners of the business, and the two owners of the business enter into a buy-sell agreement, and they say that in the event of one of the owners, the surviving owner is going to buy the business. If there is no valuation in the agreement, if instead they have words in their buy-sell agreement that says we're going to figure it out after we're gone, there's going to be some kind of an appraisal after we're gone, how would that work? Well, usually in a buy-sell agreement, in the ones I've seen where this approach has been taken, there's some words that say we're going to go hire appraisers, and the seller's family is going to hire one appraiser, the buyer's going to hire one, and if the two appraisers don't agree on what the valuation is, we're going to hire a third appraiser to kind of break the tie. And figure out what the price is going to be. Well, what's the downside of that? Well, the first downside is that it creates uncertainty. It's hard to make plans on the front end if you don't know what the buyout price is going to be on the back end. It sets up a potential fight between the family of the deceased owner and the surviving owner or owners over valuation, which probably wouldn't be healthy for the business. it makes your job harder. How do you sell the right amount of life insurance under those circumstances where you don't know what the buyout price is going to be? The other thing it has the potential to do is it has the potential to create a state tax uncertainty. These days, federal estate tax issues and federal estate taxes aren't as high as they've been in the past, but they are still a significant issue for our high net worth clients who have closely held businesses. So what does the estate tax uncertainty look like? Well, if the value of the business is not known, it can lead to an evaluation fight with the IRS. The estate's got an interest in imposing a low value on the IRS if it's possible. And the IRS has an interest in collecting as much tax revenues as it should and will try to impose a higher value on a closely held business. If you've got a valid buy-sell agreement in place, and if the buy-sell is drafted carefully, the valuation in the buy-sell agreement will convince the IRS that the value of the business that is set in the buy-sell agreement is convincing for estate tax purposes if this four-part test is met. First, the price is determined by the agreement. That is, it's not an appraisal method, it is actually determined in the agreement. Second, the terms of the agreement are binding throughout lifetime and death. The agreement's legally binding and enforceable, and the agreement was entered into for real business reasons. And it's not a device to pass the business to the beneficiaries at less than a full value. So that fourth consideration comes into play a lot in family situations where one generation perhaps is interested in selling the business to the next generation. The IRS doesn't want to make that simple to fix a value for the business at an unfairly low price for estate tax purposes. And so that's what's needed. And that's one of the good parts of buy-sell agreements is that it'll convince the IRS if those four tests are met. So how do we put in a value for a business in a buy-sell agreement, and what value should we put in? Well, the method is really the two methods that are put there. The fixed price, the parties can agree to a price today, and to protect against future uncertainty, they can come up with a different price in the future, more or less, or they can put in some kind of formula that will help determine the price, a fair price for the buyout in the future. I happen to prefer the formula approach because if the parties agree to a fixed price, even if they say in their agreement they're going to come back together and agree on a new fixed price in the future, they don't actually do it. Our business owners, once they have a buy-sell agreement in place, tend to think that that job is done and tend not to want to revisit it. So I'm a big believer in buy-sell formulas. So if you're having the conversation about valuation with the business owners and they insist that they don't know the right formula to value their business, here are some suggestions for valuation formulas. One might be a multiple of cash flow. If the business is producing, say, $100,000 of extra cash flow in a year, the right value might be something like 5 times that, 5 years worth of that. Some business valuation formulas are a percentage of gross revenue. For financial organizations, service organizations, a lot of times in buy-sell agreements, they take that approach for valuing a business. Might be something like 1 times average annual gross revenues. And for more sophisticated planning, it might be some multiple of earnings before interest or taxes and depreciation and amortization, sometimes acronymed as EBITDA. It might be some multiple like 5 or 7 times that number. And so the question is, which is correct for a particular business? And it's a bit of a trick question because One of those or none of those might be correct for a particular business. There are a lot of different factors that go into valuing a closely held business. And the factors are things that if we're having a short meeting with a business owner client, we might not know about. We might not know about the competitive landscape for that business. We might not know that there's a competitor that's just opened up across the street, or that there are barriers to entry for competitors. We might not know exactly how much a business relies on its current owner for its success. We might not know whether this is a dying industry. We might not know how long the business has been profitable. We might not know that there have been similar businesses that have been sold in the area, that the business is encumbered by debt or lease terms, or the condition needs to be replaced, or the condition's in good shape. All of those things for particular businesses might have an effect on the overall business value. Well, if it's hard to value a closely held business, how do business owners actually come up with a value? Well, the answer is that in my experience, the owners of a business usually have a pretty good idea of what it's worth, particularly if the business has been successful. They're likely to have relationships with owners of similar businesses that have sold under certain circumstances and have found out what those businesses have sold for. And so in a lot of cases, the clients will actually be able to contribute to the conversation, even if the first time around that you ask the question, they deny that they've got an idea. Usually they do have some kind of an idea. Well, how does the IRS look at it? If the IRS is forced to value a business, how does the IRS come at a business? Well, in 1998, the IRS published a book in which, or 1997, the IRS published a manual for its appeals officers on how to value a closely held business. And it says a lot of things in that book about valuation, but it starts with the market approach, and it says, and I think this is right, the best indication of the value of property being appraised, including a closely held business, is the price paid for the property in an arm's length transaction. So if you've got a business that is being valued as of the date of one of the owner's death, the best method of estimating a value is to look for what other businesses that are in the same industry, in the same area, have sold for in the recent past. And that's the IRS's best measure of how to value a closely held business. Well, what if there aren't comparable sales? What if that data just isn't available in any kind of sensible way? Well, then the IRS says you look at the income of the business. The income that the business actually produces and the projected income that the business will produce, and then you capitalize the interest. You essentially come up with a present value of that future income stream, and you come up with a value for the business. And this is particularly true of a service business. Now, it's not as good as the market approach, but the income approach does work. And then the IRS says if, for whatever reason, that doesn't feel like the right way to value a business, you come up with the cost approach. What would it cost to reproduce this business? If you were going to start up the business again, what would you have to spend to get it in the same shape as the current business? And so the question is, well, how do you come up with these numbers? Well, the answer is that you have to use some assumptions with regard to how much it would cost to buy certain assets and to get the business to a certain state for the cost approach. For the income approach, you have to make some present value and cash flow assumptions in order to come up with a valuation. And to a certain extent, those guesses are subjective. And because they're subjective, even people who are experienced in business valuation will come up with different answers. And so I think the ultimate IRS conclusion is the same conclusion that all of us can draw. And that is that because there are various ways to value a business, it's hard to know which way is the best, and it's probably not particularly helpful to average many of the factors and base the valuation on an average. You know, I've seen valuations, evaluation reports that used capitalized earnings, the income approach, and book value, and average the three methods together, and you say to the client, here, this is your result. There's no basis, at least from the IRS's perspective, in deciding that that is a valid result. First of all, because book value is rarely the right way to value a business. But then also, secondly, because there are so many assumptions associated with the other valuations that you can't know that they're right. And then the averaging of valuations that are in themselves suspect make the averaging suspect. And so the IRS isn't really convinced by that kind of an approach. Having said that, if you're one of our clients and your own client insists that they can't come up with a reasonable valuation for their own business, we can run some models based on various assumptions and give you numbers to show them, so that perhaps you can agree on what the right valuation to use for buy-sell purposes might be. We have the ability to do that, but at the end of the day, the valuations we run won't be reliable from the IRS's perspective. So since we can't actually come up with a way in a short webinar to value a business precisely, what are the practical tips that I'd like to pass to you with regard to business valuation? Well, the practical tips are these. If you're working with a client on buy-sell planning, include in the business valuation, have the attorney include in the business valuation some kind of binding buy-sell price. A fixed price approach is okay. It's not the preferred way of doing things because fixed prices go stale and clients don't revisit those, but from my perspective, a fixed price is better than doing nothing. I prefer a formula, and I prefer that the client decide that the formula that's being used is actually a fair representation of the business value, and that's the last point. At the end of the day, it's up to us to encourage our clients to fess up on what they really feel like their business is worth, and to help guide them to the right kind of formula that should be included in the buy-sell agreement so that the buyout is predictable, so that they have a sensible amount of insurance on the front end, and so their families are really properly taken care of. And of course, if you're working with somebody buy-sell wise, it's important to have regular follow-up. So to wrap this up, let me make this offer to you. If you would like a copy of a newsletter that reinforces the points about valuation that we discussed today, please email us. That's the November issue of Life Live that deals with business valuation. It is available to you free of charge. And for those of you who want to do a little bit more studying with regard to business transfer ideas for your clients, feel welcome to order our book. Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business is available now on Amazon.com. I need to brag on my co-authors. Craig Ballantyne's a CPA, and Pat Stagner is a former business broker and entrepreneur. They did a great job in providing their perspectives on selling a closely held business, not only with regard to buy-sell planning, but with regard to lifetime planning to a third party right now. And Craig offers his unique tax perspective on negotiating the best deal possible. And so I didn't want to leave this webinar without at least putting in a plug for the book. It's available on Amazon.com for $20. We're available if you have access to us through one of our client companies. Feel welcome to call anytime. Our number is 615-224-1291. To request the free material, or if you have questions about anything else in the webinar, feel welcome to email at asktheexpert@advancedunderwriting.com. That's asktheexpert@advancedunderwriting.com. I'd like to thank you for joining our webinar today. If you feel it is of use, when you get the link from Lisa with regard to the YouTube video, feel welcome to pass that along. Thanks again, and I'll look forward to talking to you in the future. Lisa, would you wrap this up for us?
Will do. Thank you, Linus, and thank you all for joining us today. As a reminder, to get the complimentary newsletter, feel welcome to email us at asktheexpert@advancedunderwriting.com. You can also email questions related to today's webinar. And finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. That's 615-224-1291. Thanks again, and best wishes for continued success in 2016.